Up, everybody? It's Big Snipe Mike here. Got on our lead options desk trader, Julian from the Discord, Accolades Discord. And before we get into anything here, everything we go over today is just our opinions, ideas, and we're just spreading what we have learned. This is not investment advice. They're not buy and sell signals. We're just going over some different things about options that we're finding, in the Discord and on Twitter. People are kind of going about it in a way that are getting other people smoked. So we just wanted to kind of touch on that, figure out, Julian knows these Greeks. He knows how to play them. So we brought Julian on here to kind of explain that to everybody. So no buy, sell signals, not investment advice. Make sure you like and subscribe if you learned something from this video, and definitely hit the link down below. Join our Discord. It's free for everybody. We have lessons like this all the time on live trading. We have alerts daily. We've got a community of traders that work together and have a good time while we're doing it. So with that, go ahead, Julian. Welcome to the video, and let us hear what you got today for the options course, the options class.
Cool. Thanks, Mike. So I'll be real quick with this. The Greeks are not as complicated as they may seem. I know a lot of people here struggle. I'm sure a lot of people don't understand what Greeks are. Greeks basically determine the premium price of a contract. So if you're not careful and you choose a contract that's on the cheaper side, but the Greeks aren't as strong, you're really going to suffer even if the stock tends to move your way. There's a lot of different things that play into that go into effect that determine your premium price. So there's 5 Greeks. There's Delta, there's Gamma, Vega, Theta, and Rho. Delta will probably by far be the most important Greek that you'll need to know to determine how much a price of premium is going to move. So for example, on one of these contracts here, these are SPY calls for March 16th. So we have 6 DTEs. We'll look for a contract with about 77. So we'll look at the 413s. You can see they're trading for $14.86. That's the bid. So you always want to multiply that by 100. If you are going to hold till expiration, you're going to have the right to purchase that amount of shares. But the goal of trading options is to sell the premium. It's not to hold till expiration. So real quick, Delta is going to be, for example, 77 cents. And now what Delta will do is every dollar that the stock moves, whether it be the first dollar up or the first dollar down, you are going to add 77 cents to $14.86 of premium. So if SPY is trading at 420 and it goes to 421, the delta is now going to add 77 cents to $14.86. And that will, like I said, if you bought it at 14.86 and now you have an increased a delta of 77 cents, you will now see that percentage gain on your premium, and you can profit that 77 cent difference. The gamma goes hand in hand with delta. What gamma does is for every second dollar move up or down, you are going to add the gamma to the delta. So if the delta for the first dollar move is 77 cents and the gamma is at 2 cents, if SPY goes to 421, you add 77 cents. That's your first dollar move. But now if SPY goes to 422, you are now going to add 2 cents to 77 cents, which equals 79 cents. So on your second dollar move, instead of adding 77 cents, you are now adding 79 cents to your current premium price.
And then that goes the same way, right? When it drops down $1, you're
Correct.
minusing that 77.
Correct.
Okay.
Correct.
Cool.
So delta and gamma play hand in hand. You're going to want gamma. Now, if the numbers for gamma are very low and you're making a quick scalp decision, you really want to focus more on the delta. But if you are looking to swing, you are looking to go long, either calls or puts, gamma is important, because if you're in a very volatile stock where you're seeing, $2 moves up, $4 move down, $6 move up, gamma can really play into effect to affect, your delta, that it will change the price of your premium drastically. So that's gamma. Vega is the implied volatility. So basically it goes hand in hand with gamma. All of these Greeks go hand in hand with each other.
So
If
one rolls
SPY,
into the next, pretty much.
right. So if Vega, let's say for the 413s are 77 cent, or the Vega 16 cent on a 77 delta, for every dollar move up or down, you're going to see an additional 16 cent be added either plus or minus to that premium price. So that like I said, it's everything is kind of working itself in, pricing itself in. And so Vega, like I said, if you're messing with a stock like Roku that sees 200, sees 215, then the next day sees 206, then the next day sees 225, Vega's really going to be crushing those contracts because the volatility is so high. The options market is really just destroying those premium contracts. So Vega is important. If you are scalping or you are day trading, it's not as important as, let's say, Delta, but it is something to note. It does affect that premium price. And then the most important one probably that you will be working against is Theta. Theta is time decay. So what Theta will do is over the course of one day, you will lose a specific amount of premium, whatever that Theta is. So on the 413s, it's 45 cents. So if you have a $14 contract, at the end of that day, depending on whatever the move went, you will lose 45 cents on that contract.
So if it opens at 420 and it closes at 420, and you had bought in the contract at $14, you're gonna lose
45 cents.
45 cents on that contract. So it's gonna drop down to 13.65.
Correct. And that's every single day. So what you guys are struggling with, what some of these guys are struggling with, is they're going for the dirt cheap contracts. They're going, let's see,
10 cent, 20 cent contracts that got 10 cent, 20 cent Theta.
Right. So let's look at the 450 calls. Right now, that bid is at 10, the ask is at 11 cent, right? The delta is at 2 cents. So for every dollar SPY moves, your 10 cent will gain or lose 2 cents. And that in of itself is a 20% move for every dollar move that it made. The gamma, let's see what the gamma is 0. So in this case, gamma is not going to multiply your delta no matter if it moves $10 up, $10 down. The gamma won't affect your premium at all. But what will kill you is the theta. So on these 450s, the theta is 4 cents. So if your contract is 10 cents, at the end of the day, you will lose 40% of value on your premium. Wow. If the stock stays at 420 the entire day, you lose 40% on that.
And these are 6 days out, right? 6 day DTE. So
these contracts, they're cheap, but a lot of you are not understanding when you guys are going red on these contracts is because this theta is crushing almost half of your value. And so
remember, go ahead. I didn't mean to cut you off. Go ahead.
So what I was just going to finish off with is, so the delta is 2 cents. So you would need SPY to move $2 and to hold that $2 just for you to break even on that day. Because like I said, again, theta is 4 cents. So at the end of the day, you lose 4 cents.
And now the theta, it doesn't all come out at once, right? It's all throughout the day. You're burning your contracts throughout the day.
Right. So periodically throughout the day, it's really no given minute of the day, but I go by hour blocks. So every hour you lose a percentage, but at the end of the day, it will total the total theta amount given
40%. Yeah. So if it stays stagnant all day, you got contract 6 days out, you're not expecting the move right away. You're expecting it in a couple of days. Let's say it opens at 420, closes at 420. You're down 40% no matter what.
Correct. So that's why I really advise you guys. Now, 10 cents a contract times 100 is what, $10? Yeah, for you guys with small accounts, that may seem like a really good deal, but when you dive into the Greeks, which is what you guys need to focus on, like I said, with this 450 call, if you're spending $100 on these contracts, you're getting 10 contracts, you're losing 40% in one day. if that stock price doesn't
Even if
move,
you're just holding it half the day, you buy them in the morning and hold it half
lose
the day, you
10,
lost
2 cents.
20% by lunch. Now,
Right.
for a newer trader, smaller account, do you think, because the market's been slow, it's been on the backside, and a lot of people are getting frustrated. They're blowing up their accounts, not just on options, but in equity. So, but they see people like posting these 1,000%ers from the options, right? And that's why they're getting into options. A lot of people, I'm seeing all these new discords pop up that are just option signal rooms. I'm seeing everybody on Twitter that's just posting option, trigger prices. Now, do you think that it'd be wise to learn the Greeks before you even bought your first contract?
Yeah, I mean, as in everything trading, you definitely want to know what you're doing. You want to know what you're buying, because in a sense, you are buying something that holds value. And so as an informed buyer, regardless of a trader, you want to understand what is going to affect your price. So I think before you even dive into contracts, you need to be able to memorize the definitions of these Greeks. Delta is basically the first dollar move. You're adding whatever delta is to the premium. Gamma, the next dollar move, the second dollar move, you're adding gamma to delta, right? Vega is implied volatility. So if the stock is going up $4, down $6, you're going to be able to price in whatever Vega is, if it's 7 cents or it's 6 cents. Now that's going to be harder to price in just off the top of your head, but you do need to understand if this stock is up 180%, and you're trying to buy a contract on a $5 stock, Vega is going to basically be working against you, trying to pull
Take your money.
premium and prove that,
Yeah.
take value off of your contract.
Yeah.
And then Theta is time decay. Theta is going to be, no matter how good of a trader you are, Theta is your worst enemy. It is there to basically steal your money, just like Vega, but Theta is a silent killer. So you may not necessarily see your contract losing value, but the next day at open, you're going to see it hit hard when they update. And so you really need to memorize what these Greeks are. And then the last one I forgot to mention is Rho. Rho doesn't really have any significance to day traders and not really anyone going long. Rho really has to, it takes into effect crazy things like bigger ETFs. So how the S&P 500 moves. And you can see on all of these contracts, Rho is literally under 10 cents. And so Rho can be based on what the weather is that day, news in the market, the world economy. Rho isn't really, you're not going to see any significant move from Rho, but you do want to understand, like we're seeing this war in Ukraine, Rho is, I think it's higher than it usually is. And that's just because outside factors of the market is what Rho, prices in to these contracts.
That's pretty cool. I didn't even know anything about Rho, so that's something interesting to learn something new. Now, as an options trader, what do you think? Max risk. You buy what you buy is what you could lose, right? So that technically is your max risk. But if you're day trading options and say you're using a big size of your account, what do you think the max risk should be on that? Like, should you just let it go to zero? Because I see a lot of people that they're like, I'm down 60%. I all in my account. I'm down 50% at the end of the day, and I don't know what to do. Should I just hold it? Should I, like, don't you think that you should treat it like you treat equities, right? And stop out, have a stop loss and cut your losses quicker than, because these things are, it's not like equities. It won't come back, right? It's got a time, it's got an expiration date. So when it comes to that expiration date, by that's closer and closer to expiration date, the Theta is going to kill the contract to the point of no return.
Right. And I think if you're down 60% on a contract, I honestly think you should not be trading options. I formed a business for my trading career. I trade under a business. I treat it as such. So I will not hold things. Now everyone's stop is different. I don't want to give a specific stop loss percentage, but
Not a percentage, but you think you should, because I know people will be like, oh, I'll buy I'll buy how much I'm willing to lose. But like you just said, this is a
Right.
business, right? You want to, the whole point of it is protection of capital. So you should never
Correct.
be willing to lose the entirety of your money, you know?
So let's say you have and I know a lot of you may not have this size account, but for example, let's use a $10,000 account. The most that I could see someone using for an options play would be at most 20% of their account. I would probably stick under the 10 to 15%. And that's just because when you start moving up into 30%, 40% of your total account value, if you lose 20% and these contracts move super quick, you've now lost not 20% of your position, but you've lost 20% of half of your portfolio. And so that is just, I see that's the quickest way new options traders with small accounts, they blow up, is because they say, oh, well, if I'm putting in 200 bucks, 20%, that's a big move, sometimes for an option, depending on what kind of stock you're trading, it's not really worth my time. And that's where people get it wrong, is it's always worth your time. Every lesson and every trade you take is going to further better you as a trader. But a lot of people will want to put 100% of their account into an options play. And usually when that happens and you lose 20%, you have now lost 20% of your entire account. And once you pull that money out, let's say you respect a stop loss, now you're down 20% of 10
Your
grand.
entire account. Yeah,
And it's not going to be, you're not going to make a 20% win off 8 grand and get it back. You know what I mean?
20% is going to knock 2 grand off your account. Then even a 20% win on 8 grand is going to only get you back 14 or 1600.
Right. So if you, like I said, if some of you guys have $500 accounts, $400 accounts, options is a way to build capital very quickly, but you have to follow a stop loss, because you will blow your account up. I've done it multiple times. I know Mike has taken some pretty serious L's pretty quickly.
Yeah.
And it's like, it's not shares where you hold it forever and then you pray you can get out.
Pray you can get out.
Options,
That's the difference that a lot of people come in, they don't realize. Like, there's an expiration date and there's theta that's going to kill your contracts throughout that entire time. So even if you hold it to expiration, and if you are a smaller account and you somehow by God's grace land in the money, your contracts will still be 99% down because of theta, and you don't have the liquidation in your account to exercise those contracts. So if you're a smaller account, you need to be, I see it, and I know it's such a quick way, right? If you're good and you catch a nice win streak in options, I've seen it happen, right? We've seen Golf Kid. Shout out to Golf Kid. He blew up his account on freaking spy calls, right? He went and hit the books, studied, came back. He was fucking a whole new person. The dude was respecting stop losses and he was playing smart. And he turned, he tripled, quadrupled his account in weeks. He was just like from one contract to the next. So it is possible to be done, but you need to, learn the Greeks, hit the books, respect a stop loss. Don't use fucking your entirety of your account, especially if you still don't know what the Greeks are. There's zero reason for you to all in into an options play when you don't have any understanding of the Greeks. And be smart about it. Ask somebody questions. Don't just jump right in, and don't follow just trigger alerts on. I see so many fucking idiots on Twitter. They put trigger alerts, but don't explain anything about the chart in the trigger. It's just like, things wick down, things wick up. You could hit a trigger alert, it could hit the trigger, but it could wick, and you can get smoked. So you gotta. There's a lot of questions that need to be asked before you just go ahead and triple your account on options, in my opinion.
Right. And then one thing to add also, so we were talking about the 10-cent contracts. Let's say you have a small account, you don't really want to go for the $1.45 contracts or the $2.28 contracts, but you want 10-cent contracts, right? So that means you're putting up $100 of capital for 10 contracts, essentially, that, as we just explained, are working against you. The Greeks are meant to work against you in this specific premium contract. If you're going to spend $100, why don't you just buy one $100 contract? So let's say this one is $1.03. You buy one contract. It has better Greeks. You've got better deltas. You've got better thetas.
Better risk to reward.
All right. And so cheaper isn't necessarily better. It's cheaper for a reason. There's a less probability of that premium price being profitable at
So
that low level.
less is more in a sense, right? And instead of getting
Exactly.
10 $10 calls, it's better. You're way better off just getting one $100 call, that's got better Greeks and better reward, better risk to your reward, because theta is your risk.
Right.
Theta and gamma are going to be your risk, and then obviously delta, or is it delta and then gamma?
It's delta. So yeah, delta and theta are probably going to move your contracts the most.
Those are going to move your contracts the most. So those numbers, you want them to be lower. So your contracts are going to cost more at the time, but you're going to end up losing more if you'll have more room to breathe. If you have a 20% stop loss, you'll have more of a move for it to come down to 20, you know what I mean? For 20%, if you're in $10 calls, moves 50 cents and you in an hour, and you might be down 20% already. And if you're in SPY calls, for instance, or if you got the $100 call option, and you've got lower Greeks, and maybe you got a whole $1.50 that it can go down before you're down 20%. So you've got a lot more breathing room.
Right.
All right. Well, with that, Julian, it's been a pleasure. I know we ran a little longer than we wanted to, but this stuff's definitely interesting stuff. I suggest everybody go out, study it. If you got questions, we're both in the Discord. If you're not in the Discord, hit the link, join us. It's free. We have a good time. We do shit like this every morning. We hop on voice and we trade live, as well as we run classes, weekend watch lists, building classes we do every Sunday. And there's a lot of fun stuff that, we run giveaways. We do all sorts of fun shit, and it's 100% free. If you got questions for Julian, he's our lead options trader in the Discord. Hit him up. I know he'll answer. He answers relatively quick. If he's not with his son out doing stuff, he'll answer you. And if you got any questions for me as well, I'm still learning the Greeks, but that's why I wanted to bring Julian on, because this teaches me too. I asked him the other day when I went to swing a SPY put 2 days ago, and he gave me a better contract than the one I chose, and I woke up 50% today. So, and I didn't have to do anything. So yeah, thanks everyone for coming out and checking us out. Make sure you like, subscribe. And Julian, you got any last words before we head off?
Yeah, I mean, you kind of finished it off there. If you have any questions, I'm always here to answer. If I'm not on my PC, it may show I'm online 24/7, but I just leave my PC running. I am always on my phone. So if you send me a text, you want to hop on a Discord call, I'm here for you guys. That's really the goal of what I'm here for. I really want to see you guys excelling in your careers. And, if I can make you a 7-figure trader, let's get it. So yeah, I'm here for any questions, advice, tips. I'm all for it.
All right. Well, with that, later, guys.